How you doing? I'm Big D. I'm from Silver, Gold, and Digital Truth Insider. We have to talk about if you own physical gold, silver, bars, rounds, anything like that, you need to understand what is happening on March 15th, 2026. And it's about the IRS and taxes. Because there's a new IRS reporting requirement that goes into effect on that date. And if you don't understand it, you could be facing penalties, audits, or even worse. The mainstream media is barely covering this. Most silver holders have no idea this is coming. But I've looked into this, and I definitely want to give you my side of what I'm seeing, and I hope you listen because this could affect you more than you know. I'm going to break it down exactly how comes to play and how it could affect you. The new rule is buried in Section 645A of the Infrastructure Investment and the Jobs Act of 2024. Now it's finally being enforced starting March 15th, 2026, and it changes how precious metals transactions are reported to the IRS. Now, before you get too crazy, I am not a professional, and I do have a disclaimer in the description below. But I have read this, and I'm going to give you my side of it. Take what I give you and do your own research, but at least this is going to give you a heads up of what's going on. First, you need to know and understand why the IRS is doing this. It's not just about silver, it's about closing what they call the precious metals reporting gap. Let's kind of get right into it. And exactly what changed. The old rules before March 15, 2026, previously, precious metals dealers only had to report certain transactions. Sales of 1,000 ounces or more of silver bars. Sales of or bags of pre 1965 US silver coins totaling $10,000 face value. Sales of specific bullion products in large quantities, most private transactions not reported. Buying from individuals not reported. Selling under the threshold not reported. The new rules effective March 15, 2026, under the new third-party payment network reporting requirement. First, the $600 threshold. Any transactions over $600 in a calendar year, whether buying or selling, must now be reported to the IRS via Forms 1099-DA. This digital asset alternative investment form, which is, again, $600 per year, totaling. So any single dealer or platform, not per transaction, total. Here's example. January, you buy $300 in silver coins at APMEX. March, you buy another 400 in silver rounds through APMEX, JM Bullion, whatever, SD Bullion, wherever you buy your metals. Total $700. Now, that dealer now has to send you and the IRS a 1099-DA showing $700 in purchases. Second, online payments platforms. If you use, say, PayPal, Venmo, Zelle, Cash App, or any payment processing or processor to buy or sell silver, even in private transactions, and you exceed $600 in transactions annually, that platform reports it. This is significant because it catches private sales that previously fell under the kind of radar, if you want to call it that, third seller reporting requirements. If you sell silver and receive more than $600 in a calendar year, Even across multiple transactions, you are now required to report it as well. Even if the buyer doesn't send you a 1099, now I know what you might be thinking, because I was thinking the same thing. This is the government tracking my silver. This is confiscation, wouldn't you think? I need to sell everything right now before this goes into effect. I don't think you need to. Now, let me separate the panic from reality. Why this is not a silver tax. This is not confiscation. This is not making silver ownership illegal. This is not retroactive. And it only applies to transactions after March 15, 2026. What this actually is it's reporting requirements to close the tax gap. It applies to all alternative investments over $600. Silver, gold, crypto, art, collectibles, etc. It's about making sure people pay capital gains tax on profits. Now, here's the key thing people might be missing. Reporting does not equal taxation. If you buy silver at $28 per ounce and sell it at $30 per ounce, you owe capital gains tax on the $2 profit. You always own that tax even before this rule. The difference is that the IRS knows about the transaction, so you can't forget to report it. But if you buy it at $28 and you sell it for $26, you have a loss. You don't owe tax. In fact, you can use that loss to offset the other gains. Now, looking at the numbers, also, say about 75% of you watching are unsubscribed, if not even more. Now, in this unfiltered real-time analyst is cutting through the noise and giving you a clearer picture of what's really happening. Please hit the subscribe button. Now, that's how we grow a community built on truth, not hype. And I do need your help. And if you don't mind, please make a comment in the comment section and I'll leave a comment for you. Now, let's see. Where do we go? Let me walk you through the exemptions and strategies that most people don't know about. Exemptions number one, in-person cash transactions. If you buy or sell silver in person, using physical cash, not check, not Venmo, actual bills, and you stay under $10,000 in a single transaction, there's no reporting requirement the way I understand it. The $600 rule only applies to transactions that go through the banks or the payment processors. Cash is still private. Exemptions number two. Collectibles and numismatic coins. Rare coins with numismatic value and treated differently. They're definitely treated differently from how I read it and understand it. Now, if you're buying a Morgan silver dollar for their collectible value, not just silver content, different rules apply. The IRS distinguishes between bullion bought for metal content and collectibles bought for rarity and conditions. Exemption number three, gifts and inheritance. If you're given or gifted silver to a family member under $18,000 per year per person, that's the 2026 gift tax exclusion. No reporting required. If you inherit silver, the cost basis steps up to market value at date of inheritance. So there's no gain to report when you eventually sell. Now let me walk you through some strategies. Strategy number one, spread purchases across multiple dealers. If you're buying $3,000 in in silver this year, instead of buying it all from one dealer, you buy $599 from dealer A, $599 from dealer B, same thing from C, same thing from D, same thing from E. Each transaction is under $600 threshold. No reporting requirement. Is this legal? Yes. Again, this is how I read it. You're not structuring transactions to evade taxes, which is illegal. You're simply exercising your right to do business with multiple vendors. Strategy number 2, buy through self-directed IRA. Silver held in a self-directed precious metals IRA isn't subject to the same reporting because the custodian handles all reporting. Gains are tax deferred in a transactional IRA or tax free in a Roth IRA. You're not taking personal possession, so the $600 rule does not apply to the same way. Strategy number 3, document everything. Starting now, keep meticulous records. Date of payment, date of purchase, the amounts paid, silver spot price that day, dealer and seller information, photos of receipts. Why? This is one of the most very important, because when you sell 5 years from now, you need to prove your cost basis. If you cannot prove it, the IRS assumes your cost basis is zero and you pay capital gains on the entire sale price. Now remember, the reason why I say that it's very important is because sometimes receipts fade, and sometimes it's almost like they're made in with invisible ink, and they are no longer legible. So why is March 15th specifically important? 2 reasons. First, last day under the old rule. Any transaction completed before March 15th fall under the old reported threshold. So if you're planning a large purchase, do it before March 15th, 2026. Means you avoid the new $600 reporting. Second, dealer system implementation. Dealers have until March 15th to update their systems to comply with the new rule. After that date, they'll be issuing a 1099 DAS for any customer who exceeds $600 in an annual transaction. Let me present both perspectives on what this means for silver investors, because this is where we need to be balanced. Bearish perspective on this rule. More government oversight is never good for privacy. Reporting requirements create compliance costs for dealers, which could increase premiums. Some investors will exit physical silver to avoid paperwork and reporting. Black market activity could increase as people try to avoid reporting. This could be a precursor to more aggressive taxation and regulation of precious metals. The $600 threshold is extremely low and captured nearly all serious silver investors. The fear is legitimate. More government involvement in any market creates friction. Bullish perspective on this rule: legitimacy. Regulated reporting makes silver more legitimate as an investment asset. Institutions won't touch unregulated markets. More regulation could mean more institutional buying. Price discovery, better tracking means better data on actual demand. This is why I think it's legit and why it's coming about. Now, when the market sees real demand numbers, price reflects reality faster. Tax loss harvesting, with reporting, investors can now properly claim losses. This creates buying opportunity when investors sell to harvest losses, removes criminal element. Unregulated markets attract money laundering and tax evaders. Clean up the market removes this stigma and attracts mainstream investment. If you're buying silver at a legitimate investment and as a legitimate investment and planning to pay your taxes on any gains, this changes almost nothing for you. You just need to understand the rules and stay compliant. My assessment: this is not the end of silver investing. This is not confiscation. This is simply the IRS doing what they always do, making sure they get their cut of any profits. For investors who were already planning to report gains and paying taxes, nothing changes except paperwork. For investors who were not planning to report, this is a wake-up call to get compliant. The practical impact for most silver stackers is minimal if you understand the rule and document properly. What you should consider doing before March 15th: review your 2025 silver purchases. Did you receive any 1099s? Make sure they match your records for 2025, tax due April 15th, 2026. If you're planning major silver purchases and want to avoid the new reporting, consider making them before March 15th under the new rule. Talk to your tax professional about whether a self-directed IRA makes sense for your silver holdings. Set up a spreadsheet to track all your silver purchases and sales starting March 15th. Don't rely on dealers to keep perfect records. Where does this leave us? 3 key takeaways, and then we're out. Number 1, new IRS reporting requirements effective March 15, 2026, lowers the threshold at $600. Any transaction over $600 in a calendar year with a single dealer or platform gets reported via Form 1099-DA. This applies to buying and selling. Online payment options, payment platforms like PayPal, Venmo, Zelle, also reporting transactions over $600 annually. This is not a new tax. It's a reporting requirement for capital gains tax you already owed. Number 2, there are exemptions and strategies to maintain privacy. In-person cash transactions under $10,000 are not reported. Collectible and numismatic coins are treated differently than bullion. Gifts under $18,000 per year and inherited silver have different rules. Spreading purchases across multiple dealers keeps each relationship under $600. Self-directed precious metal IAS have different reporting handled by custodians. Number 3, documentation is now critical for all silver investors. Start now. Keep records of every purchase date, amount paid, spot price, dealer information, receipts, copies of receipts, just in case you have a receipt that somehow disappears, the ink. And that's happened to me before, not on silver, but other things. Now, without proof of cost basis, the IRS assumes zero cost basis. You pay capital gains on the entire sale price. Now, before March 15th, review your 2025 purchases. Consider major purchases before new rule takes effect. Consult a tax professional about your specific situation. The unresolved tension is this: more government oversight reduces privacy. It also increases legitimacy and institutional participation. Now, this reporting requirement may create short-term friction, but could attract more mainstream investment long-term. In this, the first step towards more aggressive precious metal regulation, or it's the simply normalization silver as an investment asset class. Time will tell, but for now, the rules are clear. Understand them and stay compliant. Do you own do your own due diligence. Understand the risks, but accountability for your own decisions. Consult a tax professional for advice specific to your situation. And again, I'm not a tax advisor. This is general information, not tax advice. The worst thing you can do is panic and make emotional decisions based on fear. The second worst thing is to ignore the new rules and face penalties later. Stay informed, stay compliant, and don't let fear mongering change your long term strategy. If you found this valuable, please subscribe. And I'm here probably every other day, maybe every third day. And I have some really good information. I do believe that, and I hope you do too. Please leave a comment in the comment section. Try to have a great rest of your day, and God bless America. God bless you and your family.